Hi, everyone. Welcome to another weekly call. For those who don't know me, I'm Litan Yahav. I'm one of the founders and CEO of Vyzer. And I got Mike, a good friend, here with me as always. Some quick housekeeping as usual. This is being recorded. So if you have to drop off, don't worry, you can catch it on the other side when we share the recording afterwards. And please, I know, I say this every time, this is a conversation. It's not a presentation, so please feel comfortable to unmute yourself, unvideo yourself, throw things in the chat, push back, feedback. That's what makes these calls like really good. If we have a heated discussion, even better. So today we got Jeremy Roll on the call. Jeremy can share a lot of stuff. We're going to focus this specific call on the macroeconomic landscape that we're in. I'm sure there's a lot of other things we can go into after Jeremy shares his background and gives a short introduction. Mike and I and Jeremy were talking about this earlier this week. There we go, Jeremy.
Sorry,
About
guys.
You're
Yeah, I had
good.
two Zoom sessions at the same time. Zoom was doing
Uh,
something. I'm very sorry to everybody. Thanks for joining.
cool. So we were talking, Jeremy, Mike, and I on the pre-call a couple of days ago that there's a lot of things we can talk about with Jeremy, and we're going to probably have one or two follow-up calls to dive into some more, I'd say, tactical, specific matters about other things to pick his brain about. This session is going to focus 100% on the macro economy. Okay. So if you have questions that are unrelated, that's fine. You can put them in the chat. We'll address them maybe on a later call, but this is purely around the macro economy. Okay. So without further ado, Jeremy, welcome, man. Good to have you. Good to see you. Give us some background about you.
Absolutely. And again, guys, I'm so sorry to everybody for that technical difficulty. Rebooting didn't even help. So my name is Jeremy Roll, originally from Montreal, Canada. That's where I grew up. I basically spent half my life in Canada and lived the second half of my life in the US. Was actually in LA over 20 years, in Philadelphia for a little bit. I did an MBA over at the Wharton School at UPenn, and spent over 10 years in the corporate world. I'm currently near Newport Beach in California, a little south of LA. I have been a passive investor, so an LP investor in syndication since 2002, so 24 years. It started off in real estate and eventually went into some other asset classes as well. My primary focus is real estate. I actually rotated all my money from stocks and bonds into more predictable passive cash flow from '02 to '07 in response to the dot-com crash and kind of the volatility and the lack of predictability of stocks at that time. And in 2007, I was working at Toyota headquarters in LA. Had a last strong moment with my new manager when I got promoted in the corporate world, and I left the corporate world from the cash flow back in 2007. So I've been a full-time LP investor for 19 years now, but I've been investing as an LP for 24. So I have seen a lot. I personally, and I know you guys talked about this on a recent episode, but I'm personally highly diversified. And so I'm in over 60 active LLCs today. I've been in over 200 over the past 20 plus years. And looking forward to our conversation about macro today, as I spend a lot of time focusing on that.
Right. So awesome. Thank you for the background. I have two things that come to mind when I think macro at the moment, very sort of top of mind. One of them is obviously the craziness happening in the Middle East, which is, regardless of how it's affecting the world, how is it affecting the US and us as investors in the US? And the second thing I wanted to talk about was there's a whole trend of what's happening in this asset class called private credit, right? And all the redemption and the news about the Blackstones, the BlackRocks, the Cliff Waters. We talked about that with Layla last week. Just on
Yep.
the macro side, those are two things that come to mind for me. But if I were to hand the ball over to you, like what are the things that you're paying attention to now in the markets as you make decisions about, deploying and managing investments?
Yeah, absolutely. And I know Layla. I've known her for years. She's very smart. It was a good conversation you guys had. Happy to discuss that as well. Look, there's a thousand ways to invest as an LP. I say none of them are wrong. It's really whatever the best fit is for an individual. For me personally, I tend to focus very long term, so called a 10-year type opportunity. I have to think very far out because of that. And I specifically focus and stabilize stuff that may or may not have any value add upside at all potential because I look for more predictable cash flow. So with that frame of mind, I'm not focused on like a 2 or 3 year time period like some people might be, right? And nothing wrong with that. I'm focused on a 10-year timeline. So I am trying to avoid the kind of the long-term landmines, I call them. And that could come from, population shift within a country. It could come from an economic downturn. It could come from one asset class falling out of favor due to demographics or long-term, changes. So I'm constantly thinking far out. So that's why I'm so focused on macro. It's just so vital for me to think ahead. And I literally spend about 2 to 3 hours a day between the morning and nighttime just reading and watching videos about macro and trying to think about what might happen. Today, there's a lot of very short-term risks, right? It's to do with the war overseas. And we could definitely get into that today. I think part of the challenge is that very unpredictable. I mean, I watch it every day, very many times a day. So I'm very familiar with it. And I could talk about, what's been going on lately. But for someone like me, I kind of try to even think past that. And am I worried about a potential recession because of inflation? Yes, we can get into why and everything else, potentially from the war, even without the war. But I'm thinking more long term in terms of what I tend to focus on. So that's where my thoughts are going.
Give us an example of what you've been paying attention to that affects your long.
Yeah, absolutely. So, if you were to say to me, okay, Jeremy, like I've heard you're mostly on the sidelines, and that's true. What is going to get you off the sidelines, or why are you on the sidelines even, right? So I'm on the sidelines because we've had a record long amount of time where we have not had a recession. Now, we technically had a 3-month recession back in COVID. At least it was called a recession. But if you look at the real definition of recession, which is 2 quarters of negative GDP growth, we didn't have a recession. Now, what's interesting fact, and a lot of people don't know, is that if you actually rewind to 2019, we were having this exact conversation, 2019 prior to COVID, I would be telling you, I am very concerned and on the sidelines because this is a record long upcycle, longest ever between recessions at that point. So we're now extra long record that we've created here, right? And also, so that's one thing to consider is like, do you want to deploy capital at a time where you probably have a very small amount of runaway left till recession as opposed to a lot of runaway, just probability wise, right? Because I'm always thinking of probabilities. Nobody knows for sure what's going to happen. Unemployment. Okay, so the number one indicator that I always focus on is the unemployment rate. And that's because historically, we've actually never had a situation where we've had a 100 basis point increase in unemployment rate, and we've not had a recession either at that time or shortly thereafter. And that's actually already occurred. We actually went up, all the way up to, I think it was 4.6, then we were down to 4.3, and now we're at 4.44. We've already breached that. But I'm very, very focused on the unemployment rate. So the one thing I'm really watching like a hawk is the unemployment rate to indicate that we're either in a recession or about to be in a recession. And it's slowly creeping up. In my own opinion, once we get to 4.6, we're in a real red zone. And once we get to 5, you're already starting to see it in the media, but that's when it's going to be full blown in the media everywhere, right? So that's the one thing I would say I'm laser focused on. We can get into all kinds of other stuff like the price of oil, inflation, et cetera. So that's trying to keep it easy and high level. That's a very important metric.
Hey, Jeremy, from a recession, if you are going into a recession, so you said you're on the sidelines. So one, I'd like to hear what you do with your money when you're on the sidelines.
Mm-hmm.
And then also, then are there certain asset classes that you don't worry about going into for a recession versus, so sort of the ones that are like neutral, positive to like stay away from if we're headed to the recession from a general asset class type thing?
Absolutely. So, first of all, when I say I'm on the sidelines, it's not like I'm doing zero. I'm just doing a lot less than I normally do, and I'm definitely annoyed having to wait. So my general way of operating is I have a bunch of cash and treasuries, and that's been going on for a long time. And I tend to turn it every 3 to 6 months to try to get the best kind of what's the word I'm looking for? Compromise between rate and flexibility of being able to turn it into cash. Some asset classes, like for example, last year I invested in a senior housing fund that was highly diversified with long-term triple net leases. I don't normally do that, but it was highly diversified. And that's one sector where I can kind of see demand going up over time. Is there Medicare risk? You have to look at whether it's public or private pay in that particular sector, et cetera. Generally speaking, the challenge I have is that for me, because I invest in kind of a minor or no value add type situation, and because a recession theoretically would result in most asset classes having less income, potentially higher expenses continuing on, and therefore a lower NOI and a lower value, even at the same multiple, right? I would rather sit on the sidelines, wait and get that asset at a reduced price to get better cash flow from it and kind of milk out the treasuries, which aren't great, but they're there. Some other people have a philosophy of deploying their capital all the time because frankly, someone might do better than me by doing that, right? If I'm waiting on the sidelines too long, they may end up in a better scenario, but I am personally going to sleep better in terms of how I function. So again, one person's way of doing it, but that's how I do it. And so if someone is going to, so if I'm going to deploy capital right now, I'm very, very specifically watching, is this going to do well in the downturn? And actually, if you think about it too, different asset classes have different cycles, right? So let me just give you some easy examples. So apartments, because of interest rates, we all know the apartments have had a lot of carnage since 2022 when the rates went up. Okay, I personally think there's one more domino left to fall, which is a recession, to do a full reset across all the asset classes. But if you get into an apartment deal, specifically a distressed one, that's 30 to 40% below previous value, you might be somewhat well protected. Even if you have a recession, you might be able to weather through that. It's going to depend a lot on the numbers and a lot of calculations and number crunching, right? But let's take startups. Startups had a major reset in valuations and multiples in 2022 with the interest rate increases. And so there's an argument to be made that now is not necessarily a bad time to be investing in startups. I do very little of that, but the point is it runs on a different cycle, right? Retail, 2018 or 19 is when I saw it really went out of favor because of the internet potential of really dislocating a lot of retailers. And ever since then, it's kind of slowly limped back. But again, it's on a different cycle than example for multifamily, which peaked in 2021 or 22, So you have to look at every asset class differently, but you really have to take a step back and ask yourself the fundamental question is, will something do well during a downturn? And clearly, for example, a mobile home park is probably less susceptible than an office building, all things being equal, without getting into any details.
Okay. And as far as any sideline money, do you ever put money into private credit, and are you now with a potential recession coming? And then specifically within that, there's sort of the what I would call the BBC business type private credit, and then there's stuff backed up by multifamily assets specifically or single family assets specifically. Are you currently in any of those, or are you avoiding them?
Okay, so first thing I'll say is, the way that I function is that I hardly ever do debt. And the reason is because I tend to operate on the lower risk end of the spectrum for equity. So once I'm already going lower risk end of the spectrum for equity, like highly occupied, strong market, et cetera, with more predictability, I'd rather capture some upside if there is going to randomly be some over, let's say, a 7 or 10-year period than not have that possibility. So for me, I tend to not do very much debt at all. I don't do none. So I did hard money lending on single family flips from 09 to 22. Literally the day that the rates went up, the first rate increase in 22, I stopped doing new originations. I let everything taper off. And by the end of 22, I was completely out. I fully intend on going back. That's one form of private credit, right? There's a ton of forms of private credit. Where I get very concerned about private credit for us LPs right now is in two different places. The first is that I feel like once we had a bit of a blow up in multifamily, which was a very popular asset class, everyone was looking at anything but multifamily, right? And people are pivoting, and pivoting isn't necessarily bad, but it doesn't always make sense. So let's say in 2005 and 6, you're looking at housing getting crazy, or 2007, it's starting to implode, and you're looking at it getting crazy frothy, you're pivoting. Just because you're pivoting, it doesn't mean it's the right time to pivot, which goes back to macro discussion, right? And I think a lot of investors don't necessarily add that piece of the puzzle to their consideration set. And I get very worried about people pivoting to chase yield or pivoting to get away from an asset class that isn't working without thinking about where we are in the cycle and how it can be impacted, in the other pivot that they're doing. The other main thing, and I saw this in 2009 and 10 as an outsider, is the problem with these private credit funds, and you're seeing it now, and I would have told you the same thing 10 months ago before all this started, is that a lot of people think they're liquid, but when things get bad, they're really not liquid. Not only do they gate them, they can actually stop them. Stop the actual liquidity, because that's always in the documents, right? It's in this operating agreements. And I think that people tend to overestimate how easy it is to get their money out and in terms of the risk reward of them. And I don't like that aspect of it, because when times get bad, you're stuck. The way I like to picture it is, you're in the lobby of a big hotel or a ballroom, and there's 200 people and there's a fire, but only one door is unlocked. And, they're letting that one door out, and you're like, 200 people are trying to get through this one tiny door at the same time. You may not make it. That's the reality of these larger funds that are meant to kind of keep going on organically. And private credit also tends to be very correlated to the economy. That's a very big problem. Depends which type you're doing, but it's very cyclically correlated to the economy. And again, I go back to, you know, there, in my opinion, there's a time at which, and just the easiest to like use an example, 2007 or 8, where doing very little makes a lot of sense. And that's how I tend to approach things. And I'm afraid we're at that time right now.
I have a question, just on something you mentioned about the unemployment versus the recession. And we have to address the elephant in the room, which is AI and its effect on GDP and its effect on unemployment, right? You had Blocks, Dorsey's company, uh, firing or letting go of, 40% of their workforce, not because the company isn't doing well, just because he sees where AI is going and the company's doing great, but he just wants to, take the Band-Aid out fast because they don't need all those people. And even so, when you think about GDP growth and unemployment, isn't there a, disconnect of a correlation between the two as we move towards this AI productivity boom?
Oh, wow, that's a big topic. So I'm going to just pass along a few thoughts on one person's opinion, but I've thought a lot about this in terms of, from an investing perspective. So first thing I'll say is that I have very little doubt from a probability perspective that we are going to see a structural increase in the unemployment rate going forward, meaning that we're going to take a step up from where we are today in the fours to where we may stabilize somewhere else in the 7, 8s, whatever the number is going to be. You could pick any number you want. Some people say 15%, some people say 8%, whatever it is, right? But I think there's going to be a structural increase in the unemployment rate. Here's where I think a lot of the thought in media is missing an important point. If we have an economic downturn, what happens? Investors get scared, people try to get liquidity, money goes away. Okay. And I feel like AI is currently presumed to be in this just straight line uptrend. The problem is that if we have recession, it goes like this, CapEx slows and it goes like this, and then eventually it goes like this again. Okay. People are not talking about that. They're not adding in that macro thought to the equation. Okay. And if it goes like a little bit higher, but sideways, and then goes back up, a couple of things happen. We have a reduction in the improvement rate of AI and it being able to impact more and more things as quickly as people assume, right? We have kind of a temporary stall in the growth of those companies and maybe a whole effect on and domino effect on stock values, et cetera, right? But I feel like, so the reason why I'm telling you this is because I think the impact is going to be a little slower than what people are assuming. And the other thing is, if you look at all historically at the major technological revolutions, they have always been implemented slower than what people had assumed. Now, I have no idea how quickly it's going to be implemented. I always just try to use history to help us understand. But I think the big piece that people are missing is that the CapEx is going to go away for a period of time. The same thing happened with the internet, right? Amazon as a growth company didn't go away, but it had to reduce its growth because it wasn't able to raise as much capital in the 2001, 2, 3, 4 era, just like a lot of the dot-coms, and it eventually went up again, right? So that's just a natural progression of how capital works. Now, I have read that some people will believe that Trump will label AI as national security because we're basically in an AI race against China, right? For who's going to kind of get, to the, no finish line, but who's racing as quickly as possible. If that's true, then what could happen is that the US government could come in as an investor, fill the gap of CapEx that's needed. I completely see how that scenario is possible. And then maybe we don't pause quite as much as I'm thinking we will. And that's totally possible. And frankly, I think it's a 50-50 chance. I can totally see that happening.
Yeah,
right?
but I just, sorry to interrupt you. I want to focus this on one thing specifically around the correlation between unemployment and recession, right? Because you're following the unemployment rate and you're saying when it reaches 4.6 or 5%, then that's when the shit is going to hit the fan because then we're going to probably be closer to recession than we were before, correct?
Yes.
And so the question is, this in spite of this, AI productivity boom and the fact that companies can they can grow with a smaller workforce, doesn't that imply that unemployment will increase and even in the short term, but GDP will still continue to increase?
I see what you're saying. Okay. I don't agree that that's going to occur because what I think the order of events is going to be instead is that you're going to have a typical margin compression and recession as the whole economy slows. And then you're going to take the step up in the structural unemployment. And I think the first thing that's going to happen when we're in the middle of a recession is that employer is not going to look to rehire people. They're naturally going to look to AI to increase productivity. Meaning that I don't think that, so let's take an important step back. Based on all the best research I can figure, the reason why we have taken so long to not have a recession was margin increase that's not normal from all the COVID money. So the builders went to a 20% margin instead of their typical 10% margin. Why haven't they laid anybody off yet in mass numbers? Because they were able to go from 20% to 10% to their normal margin for the past few years and not have to lay anybody off. Okay. That's like the no hire, no fire everybody's talking about. But now we're actually at that line with all these companies, right? And I don't think that they're going to be able to eke out the productivity as quickly as you're referring to. And therefore, I think we're going to actually have a recession coming up soon. And during that time, we're going to take the step up in the unemployment rate because I don't think we're going to have the jobs coming back as quickly. That's when people are going to look to AI and really take that step up because it's almost going to have to be, in order to be competitive, you're going to have no choice. So you and I just have a bit of a disagreement in timing.
Yeah, fair enough. Fair enough. All right, we segued there. So let's go back. So we talked about the private credit and what's happening there and where you think that market's heading. Let's talk about.
Yeah, can I just add one more important thing to private credit?
Sure.
There's such an important point to private credit that I want to make sure everybody understands. You could be in a private credit fund that is operating truly extremely well with literally no delinquencies whatsoever, okay? And you could still have a major problem. And the problem is fear. And this is what happens in recession. The stock market crashes in a recession because of fear to an extent, right? Trying to overcorrect because of fear. And I think part of the challenge that's coming up for this space, and we're already seeing it with some of these people trying to pull money out, is they're doing it in fear. That isn't necessarily directly correlated to the performance of that private credit fund, but it's one of the risks of investing in a fund where if everybody thinks there's a fire, they're all exiting the room, even if there is no fire, right? And I think you're going to see that across some of the funds as well, unfortunately. So I just want to make sure we add that in. It's an important point because that can force the fund to liquidate assets at a discount, even though they shouldn't have to. So it's an important consideration to understand that before you invest in a private credit fund.
Great point. All right, let's move over to the other elephant, and that's the war and its effect, like I said, specifically on the U.S. on oil and everything related to oil, which is almost everything. What are your thoughts on that, on how we should look at it, how we should pay attention to it, what we should take actions on?
Yeah, so the number one thing I'm watching in that is literally the price of oil. I'm watching it multiple times a day, and I'll explain to you why. The number one, for over the past 100 years, if you look at all the recessions in the US, the number one driver of recessions is inflation. Okay, it's the price of oil, actually, specifically, getting so high that it then causes inflation, causes an economic slowdown, and eventually causes a recession. It's the number one reason, the number one cause of recessions in the US. The number two cause, which is very interesting, is actually the stock market crashing, causing a recession. It's funny, I would think it would happen the other way around, but that's not true. So this price of oil, times the amount of time that we're dealing with the high price of oil is absolutely critical. And I don't think anyone knows exactly how long we can afford the price of oil at the current price. But certainly if it goes, the higher it goes, the less time we have before it really starts to impact the economy. Everybody probably knows that oil impacts so many parts of the economy and so many parts of transportation, production of goods, et cetera. So I am watching very closely the price of oil. And what I'm very concerned about right now is that Trump, to his credit, has every time the price of oil is kind of inched up, he's then made a different announcement. I think yesterday, 2 days ago, he was talking about loosening up the restriction, 60-day restriction of how ships move oil from one part of the U.S. to another, which normally requires a U.S. ship, but there's very limited. And now that he's waived that. So every time oil goes up, he does something to try to counteract it because he knows how critical it is. But now oil's creeping up again as oil infrastructure is being targeted by Iran. And I think we're getting to this tipping point where the market realizes that Trump doesn't have enough cards in his hand to be able to mitigate oil enough if they keep going after the infrastructure. So I'd be watching that very carefully.
Are you hedging against it as well?
And it's before the war even. So I have two what I call shorts on right now. I don't normally do this kind of stuff, but I always take a big swing for the fences at the timing I think makes sense at the end of a cycle because it's like a once in a cycle type of opportunity. I'm short Bitcoin. Like I bought puts in Bitcoin, which I started at 95K. It's doing pretty well right now. I think we're about to take another leg down. I think we're actually going to end Bitcoin at 32 to 37,000. We're currently, as of today, at about 71,000. Sorry, it went down today at about 68,000. And the other short that I have, which is in puts, is the S&P 500, which I took on at about 6,900. We're currently at about 6,500. I didn't do that because of the war. I didn't do it for short term. I did it for a 6 to 9 month look because I think that if we do finally have our recession, I think there's going to be a 30 to 40+% correction in the stock market if that happens. And this is the once in a cycle time to make that bet.
You're talking Mike's language now. Like Mike is strongly a believer in that as well.
Well, getting the
Yeah, I'm
timing
not
right.
taking any action on it though. I
Well,
just
Mike, as Mike knows, getting the timing right, especially, I am not a financial advisor. Puts are very dangerous. They're very volatile. It's a real gamble. And so I'm going to reassess at the end of April because I have 1 year puts and they, as you hold them for longer, they just go down in value. So if you're going to look at any of this stuff, if anyone's listening to this, be very careful. But I try to take the short-term bet. If I get it wrong, I'll exit in April, May, June, and then try again next year type things. Very hard to time right.
Jeremy, with Bitcoin, do you think that is a something that you said, okay, it goes down to 32 to 37,000 at the end. Does it then go back up? Do you think that's a long-term
Yeah.
macro good asset, or do you think that's which camp are you in with Bitcoin long
Yeah.
term?
So I've never done this before, but as I looked into it, what's fascinating about Bitcoin is it has, I'm using these not exact right number of days, it has a 1,000-day cycle, give or take. And every 4 years, it resets. And it's very predictable. And you can overlay the charts over each other, each cycle, almost exactly. And the number of leg downs is almost matching in these types of what's happening right now. So I'm literally just playing the probabilities. What I'm planning on doing actually is, and I've never held Bitcoin long term. I've only traded it a couple times in and out, like really, really minor. Is I'm planning on taking the proceeds from, if we get down to, let's say, 40,500, I'm going to exit my puts, and I'm actually going to roll all the proceeds into a buy and hold on a 4 year timeline for Bitcoin. Because if we continue to follow the trend, you might have a 7 or 8x or maybe higher return within a 4 year period just by holding. There's going to be a ton of volatility. You have to stomach it. It's 24/7. But I'm planning on just playing the charts. And that's all I'm betting on right now is just the charts. It's amazing how specific and as exact it is if you go research it.
Litan, can I push back a little on that?
Yeah, of course.
I just find it interesting that you seem to have an aversion for the stock market, but you're willing to bet basically on Bitcoin, which doesn't have anything backing it.
Yeah,
Whereas
all
at
I'm
least the
doing.
stock market has companies, real estate has assets. To me, crypto and Bitcoin would be, for me, the basically putting it on red or black. I just wonder that.
Yeah, you're 100% right. And to me, Bitcoin, the only thing backing Bitcoin is its faith in the fact that it has limited production, which is very unusual. And I think that's what's propping Bitcoin up is the fact that everybody knows it's actually in limited quantity by definition. And so all I'm doing is literally just playing a chart. It's that simple. And so I am not trying to make it sound
But
like
if you
Bitcoin has a
couldn't
lot of
you play the
utility.
same chart with the S&P or the,
Yeah.
if you
So
look at, because if you were, I look at the last, say, 3 years returns in the total market, which is around 20%. If I would have thought even the last 2 years is 15% or something, if I would have said when I got worried, I'm going to take myself out of the market, I would have missed that. And yeah, maybe it goes down 10, 15% from here, but I've already made by staying in having a diversified portfolio that includes real estate, includes infrastructure, includes PE, it includes all of those things. I even have oil and gas investments that everybody said oil was going down to, $40. Now I imagine my oil and gas investments are going to look pretty good and over the next, few months when I start getting those distributions. So to me, it just seems I'm not smart enough to predict any of this. I don't think any of us would have predicted what's going on right now. So why not set an investment thesis that lets you deploy stuff, have enough cash to ride out the downturns, maybe a year or two worth of cash, and not try to predict all of this and just let it happen over time. That's what
yeah.
I've done over the last decade, and it seems to have worked out, I guess.
So I have two comments on that. First is absolutely nothing wrong with that. And long term, I think that's a great strategy. Frankly, it's dollar cost averaging and sitting around, you will compound. I 100% believe in that. I also 100% believe in swinging for a grand slam when I think the probability of success is higher than normal and the return is higher than normal. And I think my Bitcoin and S&P puts both have that. So just to give you an example, with my Bitcoin puts, I literally think I'm going to end up, going from $1.50 a put to $12 a put in like 6 months. It's purely liquid. right? That's a big return. My S&P is already up 4% on my 40% on my puts, and I think I'll end up at a multi 100% return if actually my thesis is correct. So these are just small, high risk bets, very short term. I actually am going to rotate a lot of money into the stock market if and when we have a major correction. Your 10 to 15%, I disagree with. If you look at the charts historically, we really have a recession. And if you look at the ratios we've hit and how long we've actually been going on an uptrend, we're literally due for, just if you look at the charts, for over a 45% correction. I'm not saying we're going to get there. The government may intervene. But the point is that I don't at all believe it's a 10 or 15% correction that's coming. It's just a difference of opinion because, frankly, nobody knows for sure.
Yeah,
Okay.
the other thing, Mark, that makes me worried is that when you look historically at the PE ratios that the broad indexes are at, historically we've never had a case where we've been at this level, which is, depending on how you look at it, anywhere from the 97th to 99th percentile on how high the forward PE ratios are. That if you look over the next 10 to 12 years, typically, you're going to be anywhere from +2 to -2 annualized during that basis at the end of it. Now, I don't know if we still go up another, we could double between now and then crash. We could crash and then grind up. We could just grind sideways. It's hard to tell. But from a risk reward ratio, I'm not currently in any public markets just because I think that there are more risks there than I see in some well-placed money into things like what Jeremy was saying. Like I agree, like multifamily or mobile home parks, there could be a problem, but at the same time, I feel like there's better chance of me finding an already distressed asset that's in good shape that wasn't run well there and to put money into that than there is in a broad index of stocks at this point in time, just because of where the PE ratios are.
I just want to add to that because it's very important everyone understands where we are historically, right? And Mike, you touched upon this. I'm going to give some other examples. And by the way, to be clear, I'm planning on rolling a lot of money into the stock market if and when we get that crash, because
Agreed.
A, it's the right time to go, but B, actually, I'm getting older, so I want some liquidity finally. So that's actually what I'm going to do with some of the cash I have, just to be clear to everybody. That being said, 2000, we peaked on the NASDAQ and the S&P 500. We did not get to break even on a nominal basis for 14 years. And at 14 years, on the S&P alone, you were negative 35% inflation adjusted 14 years later. We are at similar ratios right now. So I'm not saying that's going to happen. I frankly think there's going to be some intervention to help, et cetera. We can get into all that. The point being is that just as long as you understand where we stand, to Mike's point, in the current ratios and stuff, and again, it's risk reward, it's probabilities. That's how my brain works.
I love the discussion though, Mark. And if I'm sure you other people here have some ideas, thoughts, like please, yourself and ask. Pushing back is important. So thank you, Mark. And obviously, if you have 2 people, 3 people, you have very different opinions about everything, and so it's good stuff. All right, Jeremy, what else are you looking at? And please ask questions, guys.
Well,
We have
and
about 10
Jeremy,
minutes.
something at some point I'd like you to go over is some of the asset classes. If you were going to be putting money to work, where do you see more chances? And specifically within like multifamily, would you be in A, B, or C? What would you avoid? Would you be in value add? Would you be, into development? Those sorts of things, mobile home parks, anything like that you would more likely to put money into or more likely to avoid, like office or, something else that maybe you like or don't like. I'd love to hear any of those kind of things at some point too.
Absolutely. So just to focus in on multifamily for a second. So this year in 26, we're positioned for some distressed opportunities to come up. When I say distressed, I mean truly distressed in that they might be lower occupancy, et cetera, that have to be handed back to the lender or the bank. Those opportunities tend to be very good for anyone who's doing to do very heavy value add. And you might even be able to overcome a recession depending on the type of discount and type of occupancy you're looking at in the right market. In terms of, you have to obviously look at supply. There's been a lot of supply come online in certain markets, as you guys know. So I would be looking at that this year if you're willing to do heavy value add. As of next year, I think we're going to start to have more opportunities potentially come into play for those who aren't looking as much value add, because I think that the values are going to adjust more, possibly with the recession. And that's where you start to get into, like, you can buy something and stabilize and it starts to make sense with positive leverage. To me, like, the number one indicator, Mike, is really positive leverage. You're getting the risk for the reward. We haven't been there for years on multifamily. There hasn't been the right amount of positive leverage. If I was going to choose a class, in the way that I invest for more predictable, more stabilized cash flow, I like class B, or B plus, A minus type of product. And I stay away from C because of more, challenges with turnover with tenants. And A tends to not yield as much as I'd like. Mobile home parks are absolutely one of my favorites. They can definitely be exposed in a downturn due to unemployment. But what's crazy is that in the US historically, multifamily tends to turn 50% of tenants in a year on average, just across everything. Mobile home parks, owner-occupied homes, the majority owner-occupied homes, not rental type parks, but owner-occupied parks, they tend to turn tenants once every 9 years. That is fantastic for someone who's looking for stabilized cash flow, right, in the right places with the right management team. So that's something else to consider if you're looking for longer term cash flow. Now, again, the valuations have really, gone up in that space. I don't think that the positive leverage is enough there yet either. So I'll be looking at that probably again next year and reevaluating. I think senior housing has been very interesting for a number of years. There's a lot of challenges associated with it. There's a lot of different verticals within it. You have to be very careful and understand it really well. But certain parts of senior housing that are more stabilized with lower risk in terms of operational risk can be interesting because of increased potential demand in the US with demographic shift in the next 10 years. That tends to have higher cap rates because of the operational risk. So you can have higher cash flow than a lot of other asset classes right off the bat. Just understand the risk of what you're getting into with that. Everything else, I think, is more subject potentially to an economic recession, retail, office. Now, but again, that's a generalized statement, right? If you invest in a retail strip center that is grocery anchored with a gym, a large chain gym, and a couple other things that just aren't going away, pretty decent probability it'll be there even during a recession. If you invest in a large strip mall where the major anchor tenant is a furniture store, which historically does not do well in a recession, and may have a couple of other type of stores that don't do well in recessions, then you're obviously much more exposed. So if you're going to invest today, you really have to take a look at the rent roll, understand what you're investing in on the office side, on the retail side, and even in the industrial side, same challenge.
I have a high level question, Jeremy. It seems like you really monitor everything on a day, like all these macro trends on a daily basis. Can you share sort of what sources you use to sort of get this information accurately and easy to consume?
Yeah. I try to consume a mix of kind of mainstream and non-mainstream sources. And I think the mainstream is important to understand what the messaging is to the public and also to stay level-headed. And I think the non-mainstream is either just more specifically data-driven so you can make your own conclusions, or to try to really understand what's going on beneath the surface that the media may not want to cover for many reasons. So really easy sources, mainstream CNBC is probably the number one, mainstream of probably highest traffic finance site. Calculatedriskblog.com is a great place if you want to just look at the data that was released today on certain, government data, et cetera, just objectively with a very small amount of commentary, and they publish historical charts that have gone back years. You could just look at the chart yourself and try to interpret it. That's on the other side of the spectrum. I really like Zero Hedge. It's a lot of conspiracy going on there. To me, if you just get rid of all the political stuff it covers and just look at the economics, they tend to slice and dice what's going on. It definitely has a little bit of a negative slant to it, though. So you have to really keep that in mind. But if you want to understand what's really going on, that's a good place to be. Even with the war, kind of front run a little bit, understanding what's going on, that's a good place to get out of the mainstream media. I tend to have a Android Google feed that has now spent years adjusting to what I read, and it includes like Wall Street Journal, Forbes, MSN, Yahoo Finance. Like it now is so, those sources are more mainstream, but I also read that, but it's feeding those to me, so I'm not going and actually reading those exact websites. I like to look at Drudge Report only because, again, it's more mainstream and I can see what everyone's reading and it's just easy link, so that's more simplified. That's a good starting list anyway. Yeah, and there's a lot of stuff I actually watch videos on. So I told you guys I listen to your podcast every week, which is really good information. We're getting into what's really going on, and a whole bunch of other podcasts on YouTube. I really like YouTube, and my algorithm's now gotten to the point where it's feeding me a lot of this stuff.
That's awesome. Thanks for sharing that. Do you send any? I don't know if you do this or don't, but do you send like a newsletter out every day, just like what you're reading, what's happening? You should do that.
I don't. I just don't have time. Yeah, I don't have time.
Dude, that's what AI is for. Is set up Claude Coworker or whatever, and it'll do it for you.
I could probably leverage AI. AI is amazing for those of you who haven't tried it. I could leverage it a little bit. But I'm still. I don't want to commit to it. So we'll see.
It's just a matter of time. You won't have a choice. It's like ignoring the internet 25 years ago. That's the way I see it. Cool. Well, we're almost at time here, but if anyone has any questions, we can always go over. Uh, Steve, you
I
have a
have a
question?
question.
Yeah, go for it.
I do have a question. Jeremy, you had mentioned earlier that you're looking at longer term deals, 10 years, not looking for the upside, looking for the lower risk, looking for predictable cash flows. What kind of a target yield are you targeting when you look at those kind of investments? And I'm curious what kind of asset classes are those in?
Yeah, it's a good question. So to be fair, the challenge I have right now is that the market's shifting, cap rates have shifted, interest rates are changing, and we may have a full final reset finally, like a last domino fall with the recession. So I I'm more concerned about positive leverage than anything, just to be clear. That being said, if I'm looking kind of a B plus or A minus type asset, I really don't like going in unless I'm in the sevens in year one. Prefer to get to the eights in year two and they're going forward, which we're really not there at in most stabilized type deals at the moment. And that's because there isn't enough positive leverage. I want to be clear though, that being said, I can't just ask for that and wait 30 years for it to come. So what I'm going to have to do is reevaluate if we have a final last domino, which is a recession. I'm going to have to see how everything resets, how cap rates change, how interest rates change, how much positive leverage comes up. I'm going to have to guide my targets based off what the market's actually dictating, to be clear. So that's kind of my psychological position is I'm waiting to see where everything's going to lay out into this new cycle to see what my targets are, realistically should be as opposed to what I want.
So those 60 LLCs you're in, based upon the language you're using, it sounds to me like the majority of it's in some sort of real estate.
Yes. I've done a lot of across a lot of asset classes over the years. I am in a lot of different things, but my number one preference, because a hard asset, more predictability, et cetera, is real estate.
Okay.
And Jeremy, are you investing in there's a lot of active and passive investments into businesses and, different size businesses. Are you doing any investing in that or looking at it?
No, and this is where I get concerned about the pivot because investing in a business at the end of an economic cycle depends on the business. Most businesses not necessarily the best idea. You have to kind of account for that in the pro forma. Often that's not the case. I should have told everybody I didn't invest in any floating rate bridge loan apartment deal. And we don't really have time to get into it now, but I managed to avoid that. I also avoided the whole single family between '05 and '08. I was on the sidelines mostly. And this is all to do with like macro timing more than anything.
Generally, if you looked at the 60 deals that you have invested into long term versus the money in treasuries, what's your current, call it like treasury money right now, as a percentage of your overall portfolio?
Yeah, I'd have to think about that. And one of the challenges of my portfolio is I do have a few startups and like, what are they really worth, compared to the real portfolio? So it's very difficult to give you a real answer on that. I could tell you I have a lot of cash right now and a lot more cash than I'd like to have. And I'm getting the 4% and I live in California. So there's no state tax when I have it. So that helps a little. But I'm annoyed because I don't believe that I'm keeping up with inflation on the treasury side. It's very annoying.
I'm curious though, because you talked about your objective is cash flow and specifically in real estate, and there's a whole asset class of oil and gas or energy that does generate cash flows and less value add.
Mm-hmm.
Have you avoided that on intentionally
So
because you
yeah. I've dabbled in oil and gas directly into typically direct interests and not like, working to own the actual land and everything. Back in 15, 17, and I've had limited success. It was done at very specific timing when oil crashed. It was exactly the right time. We had a lot of operational challenges. The challenge for me with oil is that it's a lack of predictability of the income, right? Because oil can be at $150 in 2 weeks, literally, and then be at $60 later this year. That doesn't work for someone like me who's trying to get more predictable, quarterly or monthly type of returns. And the volatility of oil and the lack of predictability of oil is really just makes it the wrong thing for me. But I've tried it. I've definitely tried it.
got it, appreciate it. Any other questions from anyone? All right, cool. Listen, Jeremy, we are definitely going to have another call with you to dive into specific asset classes and to dive in, deeper there, and all the good and bad experiences that you've had in the industry. We talked before the call about your experiences also with people that aren't necessarily legit and dealing with that and the issues that happen through that. And we didn't dive into that intentionally here on the call because we really wanted to talk about macro trends. But I definitely want to dive into that in a further call down the road. So we're going to book that for sure. And For everyone who's sort of listening to the recording, feel free to join us on our next sessions. And everyone here, thank you so much for joining. Again, these conversations are much more interesting and fun for us when people ask questions and participate. So thank you all for joining and participating. And for everyone, have a great rest of your week, and see you all next week.